Accessing this webinar, you agree to be placed on our mailing list and receive our newsletter. Rest assured, we take your privacy very seriously, and we will not distribute or sell your information to anyone.
All right, great. So let's talk about that risk concept. Oh, wait, I want to do that. Oh, there it is. All right, so let's talk about that risk concept. I mean, we had a little bit of a pullback, but on the whole, we're basically not the Russell, but the other indexes are still pretty close to their highs. This is the Dow, 36.7, 36.8, whatever the hell it is, 36.7, let's say. Wait, what is that number? That's 36.5. Oh, I'm sorry, no, 36.250 or 36.3. So say 36.3 to 35.4, almost 1,000 points down. So that's like 3% maybe on the Dow. 700 to 600 is 100 points out of 47, is about 2%, 2.5%. This one, 65 to 158, is 700 points out of 16. 1,000 is I don't know. Don't have a calculator. So 700 divided by 16,000, 4%. So the Nasdaq's fallen 4%, and the Russell is down about 10%. So we have, 3%, 2.5%, 4%, 10%. But most importantly is when you look at the Russell on the year scale, is we started the year here at 2,000. And now we're at 2,100 basically. So we're only up 5% for the entire year. What is this? I forgot my tea. Wow, that was spacey. All right, I'm sorry. Contemplate the Russell for a moment. I'll be right back. You can't have a webinar with nothing to drink. That is not something I usually do. I think I need this vacation time coming up. I'm forgetting tea at a webinar. That's really bad. Anyway, so la-di-da. Oh yes. So we're only up about 5% for the year. So let's consider how much the other guys are up. And we also had a big spike in 2021 again too. So basically our entire gain for the year came in the first couple of days, in the first day or so of the year. And since then we've been squiggly, 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 and now we crash back down. The Nasdaq started the year way lower. So we went from 13,000 to 16,000 on the Nasdaq, and that has been up 3 divided by 13, 23%. And that's including the pullback. See, the thing is, if the Russell didn't earn its gain, can't hold it, why would we think that the Nasdaq can hold it? How different are the rules going to be for each index? And history has not been kind to, if you think differently, history is not your friend on that. 38 to 46 is 800. So let me say 8 divided by 38, 21%. So the Nasdaq and the S&P are both up about 20%. The Dow in January was 30,000 on the dot. Now it's 35,000. And then 5 into 35 into 30. 16.666%. Ha 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 ha. You Satan worshippers out here, a perfect number. So that's the thing. If the Russell couldn't hold its gain, and the Russell did gain at some point just as much. The Russell was up from 2,000 to 2,400. So the Russell was up 20, whatever the hell, 22%. So the Russell was up as much as the other indexes were up, and it has now fallen back to up just 5%. The Russell is often a leading indicator. And why is that? Because small cap stocks can't play the same kind of accounting tricks that big cap stocks make. Big cap stocks can accelerate their depreciation. They can move loan money around. They can reschedule their debt. They can book things in different parts of the year. They can make, large cap stocks can steer their earnings and effectively ride over rough patches. So the thing is, if the going gets tough, a small cap stock is going to show you pretty much right away in their books, because they just don't have $1 billion worth of crap to move around like a big cap stock does. But a big cap stock, because even if you look at let's see, show you the difference. So if you have IBM and you've got $110 billion market cap and you're selling 50, 60, 70 billion dollars worth of crap in a year, and you're making $10 billion in a year. Each quarter is $2 billion for this company, right? And each quarter they've got 20 billion in sales, basically 15, 20 billion in sales. So they can move $500 million of profits in and out by simply declaring. They can accelerate the depreciation of something, or they can not pay a tax. They can declare a lower tax rate based on something in the future. There's always a way in a large corporation to fudge the books. In a small corporation, it's not as easy. So, if you are, restaurant services, QSR, they have 18 billion in market cap. They have 5 billion, 6 billion. So they're making 1.5 billion in sales in a quarter, and 1.2, 1.3 billion is profits. They're dropping nice profit to the bottom line. This is a great operation. We invested in these guys at some point, I think. I hope so anyway. So these are very, very good little company. And what was I going to say? Oh, yeah. But that wasn't the point of this. So the point is, though, they don't have that kind of room to fudge their numbers. It's not as easy on this kind of sales to say, oh, here's an extra 100 million, here's an extra $200 million I can move around. Even though it seems like nothing compared to IBM moving $1 billion back and forth, the reality is they don't have the opportunity to take 10% of their revenues and declare a profit. It's a trickier proposition. So in small caps, you're going to see the warts faster than you're going to see it on the large caps. And every company does this. I mean, every company, the first quarter that they're missing, they're going to pump the numbers. They're going to figure out a way to make the numbers work and say, okay, we don't want to have a miss. We just have like 3 quarters of profit. We hit our numbers for 3 quarters, and now we're having a rough quarter. How about we fix the numbers for this quarter, and then next quarter, hopefully things will get better. But they don't, and that's why large caps will lag. It's the fact that they tend not to recognize the problem, and also the same thing for the talking, because the CEO of a small cap company is often more secure in their position than the CEO of a large cap, because everybody wants to be the CEO of a large cap company. There's a million people trying for their jobs, and it's like Game of Thrones. I mean, they want to, people want to replace them. So if they screw anything up, the board of directors are looking very quickly for the next candidate. Small cap companies tend to be, they tend to think the CEO matters, and they are going to hold on to the guy. and those guys tend to last longer in their jobs. So again, the incentive isn't there so much for the CEO to avoid taking the heat. Now, Europe is all, and that's why also Europe is a better indicator of what's going on, because Europe is much more honest than the US in their reporting. When there's a problem, the European CEO will always step up, not always, but will usually step up and say, problem, we've got something wrong, blah, blah, blah. US CEOs almost never tell you there's something wrong. They almost never say, we had a bad turn, the economy sucks, we got this and that problem. It's just not a thing in the United States. In Europe, they tend to be a lot more forthcoming about what's wrong. So there's two things you can watch then. So you can watch the Russell and you can watch the European indexes to see what's probably going on in the economy. Then you have to take into account how different is our economy from other people's. Well, the big difference in the US economy is we are ignoring the virus more than most economies are. You know, most economies are still worried about the virus and try to stop people from catching it. We don't really prioritize that. Where was I? Wait, futures. So we don't really prioritize that. And so our indexes, not the small caps, not Europe, right? Not the Nikkei, our major indexes that are all, and which are, by the way, 20% Apple, 5% Apple, more than 5% Apple. I couldn't tell you exactly on the Dow what Apple is, but you know, and Apple, which was recently a $3 trillion company at 180. Where's the whole year? So that's another big disadvantage for that. So now Apple went from 80 to 180. That's 125% gain in Apple this year. Oh, I'm sorry, that's not this year. Sorry, that's 2020. Let's try it again. That's because I was thinking that sounds like too much. So Apple went from 130 to 175, and that's what? That's 45. Sorry, so it's 40, big difference. It's impressive for 2 years. So 45 divided by 130, 35%. So Apple has been dragging things higher, and also the fact that Apple goes up and then their suppliers tend to go up and so on and so forth. So Apple's been a big, big booster for the year. A lot of stocks are way higher than they should be. Amazon is crazy high also. Oh, and of course Tesla. So Amazon, well, no, actually, you know, for the year, it's really not up that much, right? It's only up about 10% for the year. Tesla has had a crazy year, which is why Elon Musk is the Times Man of the Year. Oh, isn't that funny though? If you actually go back, you know what? It's the same thing as Apple. On a 2-year run, they're amazing. But look at this. Tesla started the year at 826, and they're only at 937 now. Darn, they didn't really go up that much for the year. And that's got to be a concern, though. You got to watch these stocks that are retracing on us are starting to get in some ugly territory. So, you know, the bottom line is, oh, it doesn't go to the end of the year. The bottom line is don't be complacent and understand that, you know, a lot of this stuff, here at 2020. So a lot of this stuff that we have this great big run here and got up to these highs, it's not necessarily deserved. And although the indexes are holding up, you got to start watching this trend of everything pulling back to where we started the year, because we're not any better off than we were at the beginning of the year. We're actually worse off. It was the stimulus, and I keep saying this, right? We got this big shot of stimulus with a couple of $1 trillion this year. That boosted things. And then we did the same thing we always do with stimulus, is people start extrapolating that, you know, you have to understand in July, what happens in July? In July, well, that's not the S&P, but SPY. There we go. So in July, people are reporting the earnings for what? They're reporting the earnings for For April, May, oh, here's a quarter. Okay, so they're reporting the earnings for this quarter. So here, they're reporting these earnings and this stimulus. So here's where we got the stimulus. This is January, February, March. Then we have April. Wait, well, it's not a quarter. What is the point of this? What amount of time is this of these lines? Here's January 1st. Here's March. That would be, well, it's not, but it's not, it's, I don't get it. I don't see what the point of that is. It's not any particular number. Maybe it's 10. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. Okay, let's say it's 10 candles. Would that be consistent? 1, 2, 3, 4, 5, 6, 7, 8. No. 1, 2, 3, 4, 5, 6, 7, 8, 9. Do you count that one? 1, 2, 3, 4, 5, 6, 7, 8, 9. 1, 3, 4, 5, 6, 7, 8, 9. So it seems to be like not for some idiotic reason that's 9 weeks. I have no idea why they would do that. That makes no sense. It's just stupid. Anyway, so you get the idea though. The point is we got stimulus sometime around here and it goes into the economy here, but it gets reported here that it went into the economy. So the results that are going into the economy get reported here, and then people start saying, oh, well, everything is great, and they're going to pass this new package and the Build Back Better and blah, blah, blah. And it's all based on expectations of money and free money and money that got pumped into the economy. It's got nothing to do with how healthy these companies actually are and how well the economy is actually functioning. So, it's okay to live in a fantasy. It's okay to be in a paradise if it's an artificial paradise, but you have to be aware that it's artificial. Like if you go to an all expenses paid resort in Jamaica or something like that, and you're in this little preserve and everything is beautiful and everything is clean and pretty and all the food is free and the drinks are free and the people are serving you and all the activities are free, and you're like, oh, let's live our life like this. It's not though. That's not real. It's not how your life can be lived. There's a bill at the end when you get home in your credit card statement. It says you spent $5,000 for your all-inclusive vacation. It wasn't free. It just felt like it was free. Cruise ships are like that too. You go on a cruise ship and you got your cabin and everything's great and they buffets and all this crap for free and all the activities are free and everything. You don't have to pick up money for a week if you don't get off the ship. It's fake. You can't decide that's how your life is going to be. And this ride that we've gotten on the market is a free ride. It's been paid for by the government. But when we get home at the end, there's going to be a bill. And you can't pretend there's no bill. And the beginning of that bill is the inflation, okay? One of the costs of doing business, one of the costs of this ride that we've had, this ride, from the virus till now, this ride, when is this even coming to, oh yes, coming here. So this ride we've had from 228 to 462, almost 100% increase on the S&P in 2 years. This ride has been fake. It's been paid for by free money that's making everything look better than it is, and so on and so forth, and it's not sustainable. And one of the costs of doing business like this is inflation. I explained some of that today in the Morning Post on why that happens, and it's not that complicated. People are sick, people stay home, businesses close, right? Less goods are produced, obviously. You can see that, right? Less goods were produced. Less services were rendered. You had less car washes last year. You went to the doctor less times. You probably went to court less times, right? A lot less lawsuits are getting processed. A lot of things are being processed People, you went to school less times. If you're a student, you spent most of your time at home. That means less janitorial staff. There's a lot of things that didn't happen. A lot of things that didn't happen. What did the government do? Instead of there being a recession, which shows the economy contracting because of all these things that didn't happen, and all these people who wouldn't get paid for the jobs that weren't happening. You know, think about window cleaners in office buildings, people who work in office buildings, people who clean the office buildings, the Starbucks people in Midtown Manhattan where there's no people. All those food service workers, all those people who sell crap, all the people in malls. I mean, think about the millions and millions and millions of people who did not produce stuff last year or produced way less piano lessons, less indoor painting, less, you know, I mean, it's an endless list. And if you think about all the things that didn't happen during the lockdowns, and not necessarily mandatory lockdown, but just during the time when we were being less in contact with people, you know, less times that you go to the gas station, less gas station employees, less movie attendance. I mean, you know, it's endless. It's the entire economy drastically slowed down. But we didn't want it to slow down. Now, for perfectly good reasons. Okay, it's not everybody's fault that they couldn't work. It's not all these people's fault. It's not all these food people's fault. It's not all the waiters' fault that there's no one to wait on. It's not all the street cleaners' fault that the streets are empty and there's nothing to clean. It's not all the garbage people's fault that you know, the Wall Street garbage people or whatever, you know, the people who work downtown, the business districts. If there's nobody at the business district, there's nothing to pick up. Not their fault. They signed up to be the garbage people. Their district is this district. You don't fire the municipal garbage workers because their district doesn't have any garbage people. What about the janitor at your school? Does he get fired? He works 20 years and he gets fired because 1 year they have the school closed? You got to keep paying people. It's just the right thing to do. It's just you're hoping this is a short-term thing that's going to pass. So we make the decision that rather, now we are in fact producing less goods and services. That's a fact. Okay, I hope I made it very clear. I mean, there's no way you can imagine that we're producing the same amount of goods and services, not to mention the factories that are shut down and not producing actual goods. You know, movies aren't being made. I mean, that's a huge part of the American economy is the movie industry. No, we didn't even make movies last year. So, you know, forget the theater attendance, forget the popcorn we didn't sell. It's just endless when you think about the hole that got blown in our economy from all this stuff. So all that happens, yet, and the government steps in and says, okay, well, we're going to give money to these people, we're going to give money to those people, we're going to give money to these businesses, we're going to give you incentives to keep your employees, you know, on staff and keep paying them something. We're going to extend unemployment. We're going to do everything we can to push money into the economy and keep things looking like they were when things were open. So we're basically trying to maintain the economy at pretty much the level that it was when things were working, even though 10%, 20%, I'd say at least 20% less goods and services are being produced. We're going to push in the equivalent amount of money as if these people were still producing. Now, whether it goes to the right people or not, whatever, they can't help that. It's just there's no way to aim properly when you're doing something like this. They do the best that they can. And honestly, on the whole, they did a pretty good job of most people got money. There weren't too many horror stories about people who got totally wiped out by COVID and so on and so forth. So great. Okay. But that's the problem. There's a double cost to that. Cost number one is the economy, is the government is going massively into debt to maintain this facade. So the government racks up $4 trillion worth of debt last year and another $3 trillion something this year of debt. So $7 trillion of direct debt. Now, they would have been $1 trillion in debt anyway, but that's, you know, so let's say that. I mean, you know, so out of $7 trillion, we were racking up $1 trillion a year debts for many, many years. But it's an extra 5 trillion, and the reality is we are 7 trillion more in debt over 2 years, not counting the money the Fed put into the system to make sure the banks didn't suffer. And how do the banks suffer? People couldn't pay their mortgages. People couldn't pay their rents. So to avert defaults like China has with Evergrande and stuff like that, the Fed has been taking care of the banks, lowering rates, making it easy to borrow and refinance, and so on and so forth. Great. Okay. All this stuff gets done. But the bottom line is, now you've got all these people who have the same money, aggregately, the same money as they had in 2019, spending it on 20% less goods. Like, for example, toilet paper. So there's a shortage of toilet paper. Why is there a shortage of toilet paper? Because we use toilet paper in mass quantities. And it's the kind of thing that, like, you don't keep too much of it around. It's a pretty predictable supply and demand for toilet paper. Okay, people use about the same amount of toilet paper all the time. So for 300 million people in America, there is only so many places making toilet paper, and so much imported toilet paper coming in, and it's not that fast to build a toilet paper factory and have a new supply of trees and pulp for whatever to mill it and so on and so forth. There's a whole bunch of stuff has to happen if you want to increase the supply of toilet paper. That doesn't happen fast. Not only that, though, but you don't want to go to the bother and expense of building a factory and building a supply chain for more toilet paper when you know for pretty much a fact that as soon as things get back to normal, there's no way to sustain that demand. As soon as things go back to normal, people are going to go back to a normal consumption. That's what happens with these panics and these and when people start stockpiling, it's a disaster, especially for things where you can't really have a demand slide. So what happens is people start finding the toilet paper is in short supply, so they start paying more and more money for toilet paper and drive up the price, inflation, right? That's a drastic short-term way of looking at it. But the same thing happens when you can't find your iced tea that I'm drinking now, right? So I have my green teas that I drink, and they got more expensive. And why do they get more expensive? Well, less tea farming in Japan and wherever the hell else they pick this stuff. Less tea farming in Japan, less bottles are manufactured at the bottling plant, the ships are backed up at the ports because there aren't enough workers and blah, blah, blah. And all of this leads to less of these on the shelf, so they raise the prices, and my money chases after it and pays whatever. So, you know, if it was $20 for a dozen last year, in fact, it was like 19. I used to last year, I wouldn't buy them if they were over like 21. I would refuse to buy a 24 pack because I just didn't want to pay more than over a dollar. I was like, I'm not paying more than $1 for these things. It's ridiculous. But then now they're like $1.50, $2 even sometimes. I mean, it's really crazy how much they charge you for the green tea. And so, you know, I'm inelastic in my demand, so I keep buying it. Other people might be elastic and they buy something else. But the point is the tea itself gets more expensive. Same thing with cars. Any of you guys who went to buy cars recently probably got some sticker shock. That's what drives inflation. And there's a question as to whether the inflation is sticky or not, how much it is. But once you get to a point where you have enough inflation, and this is because, again, the same amount of money is chasing less goods, and people start seeing very marginally, but you start seeing shortages. You start running out of things like cream cheese. We ran out of cream cheese last week. You know, it's just weird things get disrupted in these situations. But it's, again, because if it was a natural recession and we all were poorer, and again, in the aggregate, if we were poorer, we would buy less goods, right? When you have no money, you buy less goods. But we don't have no money. We have money. We want the goods. We just can't find them. So, so we're trying to buy the same amount of goods, but the same amount of goods aren't available. So there's somewhat of an auction process to buy the things that are available. That's inflation. Once inflation cycles back to wages, once the companies start having to pay more money to retain the workers or get the workers into their jobs to keep the supply up and try to push things through, once it hits the wages, it's almost impossible to roll back. Because how often in life have you taken a pay cut? And I don't mean when you lose your job at a fancy job at one company and you don't get as good of a job at the next company, but I mean, for ordinary people who work like regular jobs, how often do they get negative salary things? They might get no bonuses, they might get no raises, they might get their benefits cut, but almost nobody goes back and says, okay, everybody's getting 10% less next year. That's just not really a thing. So that's why all this year, as Powell's been saying that inflation was transitory, I've been saying he's a moron, because once wages go up, it's not transitory. It's embedded in the population. And now these people are always going to have this money to push after the goods. And until a very, very long time, when the amount of goods starts catching up to the money that's chasing it, that's when inflation might start coming back down. But this is a global thing. This isn't a local problem. This is a global thing that we've done, and it's going to be a very, very long time before it gets fixed. I mean, there's 100 ships backed up at the port of Los Angeles, and how many ships per day Los Angeles? So facts and figures. Okay, so there's 75, okay, yeah, 43 miles of waterfront. That's amazing. 43 miles. Yeah, if you ever drive past there, it's just incredible. There are 25 terminals, 82 cranes, vessel arrivals, all types. Oh, here you go. Okay, so there's a good indicator. So it's in 2019, a normal year, 1867 divided by 365, 5 ships a day. Okay, so we process 5 ships a day in a normal year. There's 100 ships backed up at the port of Los Angeles. You can't make that up in 20 days because you process 5 ships a day, because every day 5 more ships are coming behind them. So even if you increase your capacity by 20% to 6 ships a day, it'll take you 100 days to work through the backlog. But the problem is we aren't able to increase our capacity by 6 ships a day. All right, and look what's coming in. That's interesting. So furniture, auto parts, apparel. By the way, furniture, that's why we shorted Wegmans, remember? Was it Wegmans? Whatever they're called. Wayfair. Top 5 containerized exports. We send out paper, we send out animal food, we send out soybeans, we send out scrap metal, we send out fabrics. See, it's good to know, right? Here's what you make your bets on. But remember, right, we shorted Wayfair furniture. This is why. Number 1 import, furniture. So even though Wayfair was an online furniture store, eventually their whole model was going to collapse. That seemed pretty obvious to us. And yeah, they did really good during the early part of the pandemic. Why did they do good? Because you couldn't go out and get furniture. You couldn't go to the furniture store. So you had to buy it online. So they started booming with their online business, but then they start running out of furniture and the model starts collapsing. And even worse, once things reopen, who really wants to buy furniture online? Don't you want to like sit in the couch? Don't you want to try your furniture? Not, you know, it's like that's one of the things that you don't really want to get online. You do it because you have to. You know, you might do it because it's cheap. I know that obviously people go to the furniture store and then order from Wayfair if it's cheaper or something like that. You know, they'll try something and then order it online. But reality-wise, their model is not conducive to having these massive gains. And so normally they were doing good. They're a good little operation. They were going up and up at a steady pace, and they should have gone up. But when they went up to here, this was stupid. So we bet against them, not complicated. This was way too much. And we started betting against them around here at $300 something. I was like, screw this. I was like, you got to short this one. Where were we? Ships, right? Okay, so like I said, that's what people don't realize. You go, ooh, 2,000 ships, that's a lot. So it's only 100 backed up. Yeah, but you got to understand how it works. If it's only 5 ships a day and you're 100 backed up, it's not like you can get rid of those 100 ships in 20 days. It's not possible. There are only 80, no, wait, what was that number? How many cranes? Wait a minute. On dock, rail, and 6 rail yards. Oh, yeah. Ship to shore container cranes. Right. Okay, 82. There's only 82 cranes. And they use several of them per ship. There's only 116 miles of docks. Okay, I'm sorry, not docks. There's only 100, there's X amount of rail tracks to take these containers off the ship physically. It can't be done. How many containers? 9.3 million containers. That's a lot of containers. So these 82 cranes have to move 9.3 million. So let's see, hang on a second, let's figure this out. So you got 9.3 million containers divided by 365 days. That's 25,000 a day divided by 82. This is how we figure things out. 300. That's pretty freaking impressive. These 82 cranes are moving 300 containers a day each. That is really impressive, actually. So you can imagine that they're probably running at capacity. You can't just say, okay, let's do 600 containers a day with each crane. It's just not going to happen. So, and you're not going to change it, and you're not going to build more ports and dig more docks and so on and so forth. All this is like going to take a massive amount of time, cost massive amounts of money, and once you clear the backlog, it'll all be wasted space, wasted capacity. Why? Because the economy didn't grow. You just have a backlog. We're not permanently going to do this. And why not? The population didn't grow. Not only that, though, but now we're going to face the backlash of the American consumer society because we already are the peak consumers on the planet Earth. Nobody consumes like Americans. And so we can't consume more. So in other words, if our population isn't growing, we've talked about this before, our population is not growing. We're not even at 1%. We don't even grow 1% a year. So you're not getting your GDP growth out of population growth. A lot of other countries, most of their GDP growth is because of population growth. We're not like that. Europe's not like that. We have a declining we have a static population, a fairly static population. Europe is practically a declining population. Japan is a declining population. There's less people in Japan every year. So how do you expect to have this economic growth? Well, people have to consume more. Each person has to consume more. And that's, I mean, step one would be, alleviate poverty and make the poor people, put the poor people up and let them consume more. That's a good idea. But realistically, it's not really something that you're going to get a lot of growth out of. So it's tricky. And you can't say, how is the capacity of, think about it, how much more furniture can you buy? How many more auto parts do you need? How much more clothing do you need? How many more iPads? I got a phone. I don't want two. I do have two iPads. I use my iPad all the time. Like if one iPad goes, as soon as one iPad's out of power, I just go right, I go boom, switch it out. So I have two iPads, but still that's my limit. I can't. I don't know what I would do with a third iPad. There's no point. So now plastics. I'm holding my plastic bottle right now, so I guess I'm doing my share on plastic. See, that's a funny thing. People just don't realize how much plastic we consume. That's insane, isn't it? That is a nasty number. So in other words, what's going to grow your GDP? How are you going to expand it? How are you going to get everybody to have twice as much furniture? If you're going to expand your GDP, these things have to grow. They're not going to grow 10%. They're not going to grow 20%. And if you're growing 5% a year, that means by the end of the decade, you need 50% more consumption. So if you project 3 million more people, so we'll have, let's say we have 320 million now, plus 30 million is 350. So let's say, so in other words, we're going to go from 320 million to 350 million people by the end of the decade. And that's with 1% growth, and we're not even there. So how are these things going to grow? Now, so your embedded GDP growth is going to be, what do we say, 10%? So your embedded GDP growth is going to be 1% a year. Okay, great. But how are you going to get 6% GDP growth? How are we going to get 50% more furniture when we only added 30 million people? How are we going to have 50% more auto parts? We're going to drive more cars? No, actually, and you know what's weird about auto parts, which, by the way, think about what a big deal this is. Auto parts are for internal combustion engines, right? Now, all autos have parts, but the number of parts in a Tesla, because, you know, they like electric cars. If you ever had an electric car when you were a kid, right? You know how it works. It's like the car is nothing. The car is a piece of plastic on top of a little sled thing that has 4 wheels and a battery, basically, in the middle. The middle is like a battery with a turbine of some sort, whatever it's called. I can't think of the word. Anyway, spinny thing. So it's a battery with a spinny thing that makes the wheels go. Boom. So it's not like an internal combustion engine. There's not like 35 parts to it. There is no muffler. There is no exhaust pipe. There's no pistons. That whole thing isn't there. There's no fan belts. There's no, I don't think there's engine coolant either, right? I don't know. I don't know how to keep them cool. Anyway, point being, there's a lot less parts. So the more electric cars we have, the less auto parts we're going to need. And that's why also you got to think about these auto parts stores as a long-term negative investment spinning down. Apparel is another one. Interestingly, right? We're wearing less clothes. If we're the people staying at home are not wearing the suits. They're not wearing the shirts. They're not wearing the ties. The dry cleaners are suffering, I'm sure. There's a lot of that kind of stuff you have to think about. So anyway, all aspects of the economy and all things that slow down, but you got to be realistic. And this is where the inflation comes in, though. So we're not buying this stuff, or it's not, and it's not even, we're not buying a lot of these things, but the things we are buying are in scarce supply, basically. Oh, I didn't even know pet and animal feed is our #1 export. Isn't that weird? Who would think that's like a huge industry? Pet animal feed. Well, I think it's more animal feed. I think we're talking about like grains and crap. That I could see. Yeah, I guess we export a lot of our grains to feed animals around the world. Scrap metal. We send out a lot of metal. So anyway, so that's the inflation issue. If anybody's got questions of anything. Nobody has questions. Wow, I must be doing a fantastic or terrible job, one of the two. And how's the market looking? Market's very sad, very flat, nothing going on. The Fed, the Fed's about to speak, so we'll see what Powell has to say. See if I can get my machine to work here. CNBC. Is it gonna work? No. Is that my power? Oh, there you go. CNBC. Oh, shit. Continue. Don't. That's not CNBC. All right, Bloomberg seems to be working. All right, so inflation. Inflation embedded, people are getting more wages. Those people are going to spend their money. It's going to move through the economy. They'll chase goods and services. We don't have the ability, that's how we got talking about the ports. We don't have the ability to supply more stuff. Because, you know, if you say, oh, well, we should build more factories in America. Well, you can build more factories in America, but then again, it's not a good investment. If you come to me and say, Phil, we're not getting sneakers from Asia because the ports are backed up, and that's why, by the way, sneaker costs have gone crazy. We're not getting sneakers from Asia because the ports are backed up. So how about we build some sneaker plants over here? And you're like, oh, that sounds like a good idea, but it's not a good idea because once you build a plant, which will take you 2 years, and once you develop a source of rubber and whatever else you need for a supply chain for your sneaker plant, and you spend all this money and lay all this crap out, you're doing so with these rising American wages. And by the time that you're up and running and selling your first sneaker, the boats are full of sneakers coming in from Asia. And the ports are cleared up. And then what do you got? You got a huge wasted investment that never made you a dime. And this is how the venture capitalists look at these things. It's like they don't want to start making larger supply. They don't want to fix it. It's not very elastic, your supply, because you cannot show the long-term growth. And that's where I get back to the population thing. Our population isn't growing fast enough to project long-term growth. We are not going to have 50% more furniture. We are not going to have 50% more cars. We're not going to have 50% more, whatever the hell we were talking about, electronics. We're not going to have 50% more phones. We are peak consumers. And you know why we're peak consumers? Because every single one of you guys, every single person I'm talking to has a phone. Everybody has a phone. I mean, a mobile phone. You know, you have a mobile phone, you have a smartphone. Everybody's got a top of the line phone. Probably most of you have an iPad or something like an iPad. We have all this stuff already. We've got the computer, we've got the laptop, we've got, you know, I mean, how many chairs can you sit in? It's not that easy to grow your economy, constantly grow. And unfortunately, all the models we have are growth-based models. There's no static-based model. The very big problem in capitalism is that you don't allow for a static economy. A static economy is a complete failure in capitalism, and that's a problem because you can't, especially when you say at some point you've got to say we've peaked the population. So can the Fed fix it is the question. And the thing the Fed, so now what's the Fed going to do? The Fed is going to make money more expensive. If they make money more expensive, then now, and the interesting thing is when the Fed makes a policy decision, it more affects the rich people than the poor people, because the poor people can't afford to borrow money anyway. you know, their credit card debt goes up and whatever, but they can't really, you know, people have no money, don't borrow a lot of money. So when the Fed raises rates, it really hits the big spending guys first, and you're sucking money out of the economy. It is not going to stop people from buying toilet paper. It's not going to stop people from buying the one chair that they do need or whatever. Those parts of the economy are not as affected, but major purchases, big loans, long-term items, housing gets affected. But housing is also a very, very big driver of the overall economy. And that goes back to furniture again. But you know, we're not in a normal economy still, and and that's the problem again. Tinkering in an abnormal economy is not necessarily going to give you the right results. You gotta, you know, we haven't even let the economy normalize, and you could say you can't afford to let the economy normalize. You can't afford to wait for the economy to normalize, because it will normalize in a disaster. We should be in a recession or depression, but we're not, because the government spent the money it took, which was, as I said, $5+ billion in 2 years, 25% of our total GDP. 25% of a 1-year GDP was spent in 2 years to stop us from having a recession or depression. That's not counting the billions of dollars on the Fed, the additional $6 billion the Fed put on their own balance sheet, which is also basically stimulus. So massive, massive, massive stimulus to avoid a depression. Would the depression have been worse than letting the virus run? I mean, then not. Yeah, I mean, would the depression have been worse than what they did than the aftermath? That's the question. But I think the real problem is that there's the assumption that you're going to grow your way out of debt, and we're not. We're in a fairly static economy. You're not going to grow your way out of debt. And therefore, all the assumptions they're making about this model, about allowing your debt to spiral into a situation where it's now $32 trillion, or will be next year, $32 trillion, you're like, how are you going to pay that back? You can't grow your way out of $32 trillion in debt in a $20 trillion economy. It's the same as the shipping thing, right? You can't pay it back. We're running, it's a $20 trillion economy running $1 trillion annual deficit, not counting paying back the $32 trillion. So we have $1 trillion annual deficit added to the 20 trillion. That's 5% every year more in debt. How are we going to pay off 150%, 160% of our GDP in debt when we're running a 5% deficit every year? Even if we try to pay it off in 32 years, we'd have to reverse the 1 trillion deficit that we have and cut another trillion somewhere and spend $1 trillion less and use that to pay down the debt. How are we going to do that? You can't. It's not doable. It's not payable. So the Fed can raise rates, but then raising rates exacerbates the deficit, because then we have to pay back more interest on the debt, and that's going to lead to higher levels of debt down the road, and then maybe we'll be running a $2 trillion annual GDP. 10% of our economy will be debt every year. And when you're running a 5% deficit every year and you have 6%, we don't have 6% growth. I shouldn't even say that. When you pretend to have 6% growth, but when you have 6% growth, or 3%, when you really have 2% growth and you're running a 5% deficit every year, you don't have growth. So, you know, let's, and again, you know, this is a, you know, you're back at Club Med, right? Is Club Med even a thing anymore? Does that still exist? You're whatever, one of those places in Jamaica, like an all expense paid resort. That's what you are, though. You're going to leave this resort at some point. We as a country are going to leave the safety of this resort, and we are going to go out in the real world, and they are going to hit us with the bill. And not only will they hit us with that bill, which is what happens. You come home from your little all expense paid vacation, and suddenly when you get off the plane to the airport, they ask you for money. And you're like, what do you mean? I just want to get some free food. They're like, there is no free food. Go get, you need money to get food. So now you need to pay for your food. You need to pay for your activities. You have to pay for everything out the other side. And they want you to pay the bill for the stuff that you did that you thought was free. It wasn't actually free in the first place. You paid for everything at that resort where things seem to be free. And that's, and by the way, if somebody told you that wasn't fair, you would be like, well, you're an idiot. What did you expect was going to happen? Did you really think you were going to go to this place and they give you free food and a free room and free activities and take care of you and everything is free and nobody ever asks you for money? Did you really think that was going to be your life? That would be stupid, right? But that's how we are treating the economy. That's how we're treating the government, the economy, the debt, the Fed, everything. We act like this is going to continue forever and we'll never have to pay for it. And it's bullshit. And it's, so like I said, it's okay to enjoy the all expense paid vacation while we're on it. But don't get sucked into the fantasy that it's never going to end. Because it will end and we're going to have some very harsh realities to deal with. Fed doubles their taper signal. Oh, the Fed doubles their taper, so they're going to taper twice as fast as they said they were going to. And they are going to hike 3 times in 2022. Okay. That seems to be the summary. We'll see what Powell has to say in a little bit. So there you go. So the Fed is now on the path to actually tapering, and Bloomberg should have la la la. Oh, come on. I subscribe to you. Don't I? Bloomberg.com. Hospitals. Why is I can see it on the screen here, but I can't get it off of this thing? This is very annoying. Elon Musk faces a $10 billion tax bill. Ouch. Ouch. It's like that scene in The Jerk where he's like writing out a check, like $10 billion. Did you imagine? How long ago was $10 billion the richest man on earth? Not long. Let's see. Richest man in the world by year. I'm not the first person to ask that question. Wealthiest historical richest man each year from 1987. That's not going to do it. 1987. Oh, here you go, though. Look. Yoshiaki Tsutsumi of Cebu Railway. Who even knew who this guy was? That's interesting. I don't know this guy's name. Anyway, so he had $20 billion in 1987. That was the richest man on earth. And now we're telling Elon Musk he has to pay $10 billion in tax. Oh, look at that. 1988, still had the money. 89, wow. How did I not know this guy? 90, look at his money going down, though. What the hell is he doing? Dude, he was losing his money. He fell off the list. I don't know what you did, mister. He had $20 billion he spent in 3 years. He was down to 16. $4 billion in 3 years. Damn. This is back when we used to worship Japan, right? We all thought Japan was going to be the most powerful country on earth because this is what they were doing. They had all these guys. Oh, he's back. Look, he's back. Oh no, 9 billion. Holy crap. You poor guy. What did you do? Oh, he's buying real estate. Dude, that was a terrible idea. 8.5. Last year on the list, he dropped off entirely after serious scandals in his 2005 arrest. Oh no. See, I had too much of a social life back then. I just didn't pay attention to these people. Bill Gates shows up. $12 billion. All right, so here you go though. Let's get back to this concept. In 1995, $12 billion was the richest man on the planet. 25 years ago. He was really nerdy back then. Bill Gates, 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 Bill Gates. That's crazy. Bill Gates, Buffett. Buffett, Gates gets back. Carlos Slim. Wow. Bill Gates comes back. Bill Gates. I guess it was time for a Windows update, right? Bill Gates comes back. Bezos. Musk. Oh, where's his number? They don't have a number. 185 billion. That was early in the year. He's got way more now. Anyway, what was the point of that? We were talking about it for some reason. Oh yeah, because Elon Musk. So poor Elon Musk. 25 years ago, $10 billion was half of Bill Gates' entire fortune, which made him the richest man in the world. And that's Elon Musk's tax bill. And that's nothing. That's his whole 185 is unrealized capital gains. So if he ever tries to cash that out or whatever, he's got to pay 50% of it in taxes or 30% in taxes or whatever. Oh, I don't know, long-term capital gains. I don't know what it is now. He'll work it out, I'm sure. Meanwhile, the government, if the government needs money, shouldn't they go to Elon Musk and say, hey, just give us, $50 billion and we'll call it a day. It's like we could use the 50 billion now. Why are we going to mess around? Okay, you're only going to fight it for your whole life. So give us 50 billion now, keep $150 billion. Have a nice day. The government has $50 billion. It'd be nice to spend. Who does inflation harm more, the poor or the rich? How do you even ask that question? That is not a real question. Oh yeah, what was I looking for? Yes, I remember now. I was looking for the Fed statement, and we don't have the Fed statement. Oh, full coverage Federal Reserve decision. Here we go. I don't want to see it. I don't want to hear it. I want to do the side thing. I don't know. Oh, here you go. Fed doubles taper signals 3 hikes and blah, blah, blah. The Federal Reserve officials intensified their battle on inflation, heading up hawkish poverty. Okay, one of the most hawkish policy pivots in years. The central bank said Wednesday it will double the pace at scaling back purchases of treasuries to $30 billion a month. So they're going to cut it pretty quickly. They're doing $120 billion a month total. $30 billion a month means as of March there will be no more. There will be no more. No more QE as of March. That's really aggressive. Rather than mid-years originally planned. The faster pullback puts Jerome Powell in position to raise rates earlier than previously expected to counter price pressures. Even as pandemic poses a challenge, the Fed flagged concerns over the new Omicron, saying risks to the economic outlook remain, including new variants of the virus. Okay, so look, Powell agrees with me. He thinks you can't ignore this shit. Here's the dot plot. They're still only really at about 1%, not even 1% next year. But look at this, and then you go on to 1.5, and you're at 2.5. How are we gonna have 2.5% interest on 32 trillion in debt? That's 32, and it'll be more than 32 by the time, times 0.025. $800 billion a year in interest fees at that level. So now we have $1 trillion a year interest payment on top of the debt and the deficit. So now we're going to fall $3 trillion a year in the hole. We have a $1 trillion interest. We have a $1 trillion deficit. We have a $1 trillion interest payment. That's $2 trillion a year out the window on deficit, on additional deficit and interest. And the question is, do you count that twice? You have to pay $800 billion in interest. Yeah, you do. You count that twice, unfortunately. Well, you have outgoing interest. Oh yeah. You know what happens? Because your deficit would be more. So in other words, you have to pay the $800 billion in interest, but to get it, you have to borrow $800 billion more dollars because you're already running a deficit. So your deficit, well, it really doesn't. You really wouldn't count it twice. So you're basically you're running your deficit up to the same amount. So you're paying $2 billion. You're losing $2 trillion a year, however you count it. In additional deficit and interest payments is $2 trillion a year. But the thing that it is though is that every year you're racking your total deficit up another $2 trillion. Now, so now you're growing your deficit 10% a year in order to pay your deficit at 2.5%. Now, the problem is if you're running a 10% deficit every single year, people are going to charge you more money to lend you money. And suddenly it goes to 5%, and now you're suddenly paying 20% a year in deficit, and you're screwed. You're totally screwed. So we got that to look for. And again, what's the solution? The solution, which is a fantasy, is grow your economy big enough to take care of it. How? How do we double the economy? The only way to double the economy, by the way, is to inflate. It's not that we can consume more, but we can all spend more for all the goods and services. If we grow the price of things 100%, that's a realistic goal. We can increase the price of everything by 100%, then we'll have a bigger GDP, and then we'll have more money, and so on and so forth, and then we'll collect more taxes, but it's all the same money. It's net the same money. What you're doing, though, is you're screwing the people who lent you the money on the long term, because they lent you money at, let's say, 2.5%, right? A 30-year note at 2.5%. They lent you that money for 30 years, but by the time you pay them back, the money is only worth a third of what it was, or less than a third of what it was. So now you're paying them back in money that's worth a lot less. You have screwed all your bondholders. This is why the bondholders begin demanding more and more interest. You have to keep up with your declining value of what you're repaying them. But we already have $30 trillion worth of bondholders we get to screw. So we can screw them first and then borrow the additional funds at the higher rates. And hopefully it'll be a lesser percentage of the GDP. That's the kind of mess we're in, though. We are in a mess. And there's no easy way to fix it. And the Fed has no real choice but to raise rates. Because if they don't, and the other thing is, if the Fed doesn't raise the rates, the bondholders are going to raise the rates anyway. The bondholders are going to refuse to buy our notes. And if the bondholders refuse to buy our notes, then you have to raise your rates to incentivize the bondholders to buy our notes, so on and so forth. All this is not going to work, though. They're doing too much at once here now. They're so worried about inflation running away, getting crazy, and I mean like, Turkey, Argentina, kind of Chile crazy, like 20, 30, 40% a year kind of inflation. They're so worried about that now that they're overcompensating. And again, this is because Powell pretended there was no inflation all year long. Now he's like, oh my God, inflation. So they're slamming their foot on the brakes. But the problem is the Fed is buying at this very moment now, is buying $120 billion a month of bonds and mortgage securities from the banks. If the mortgages are not improving and we still have to borrow, so let's focus on the bonds. It's $80 billion a month worth of bonds the Fed buys. We are running a official deficit of $1 trillion. So the Fed is buying 80% of our monthly deficit, basically. The Fed is paying for 80% of our monthly deficit by buying the bonds at low rates. They're going to stop doing that, and they're going to expect who to step in and buy it. This has to happen in March and April. Who's stepping in to buy these bonds at the stupid low prices the Fed has been paying? That's a problem. So this marks a major shift in the forecast and blah, 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 blah. And meanwhile, the market is surprisingly going up because the Fed is doing the responsible thing. It's what they should be doing, but the repercussions of this are not going to be pretty. All right, so we'll see what happens. I think this is a false move. I don't think this is going to last because the long-term repercussions of this, as people start discussing it, is not going to be a pretty picture. So that'll be very, very interesting. Look at oil shoot up on this news. That's interesting. Gold doesn't know what to do. Gold's all over the place. Oh, 1750, that's our buy spot on oil, on gold. I mean, 1750 is a buy line. Didn't quite hit it. So we will see what happens. But meanwhile, you know, we just did the short-term portfolio review the other day. Oh, it was yesterday, right? So in the short-term portfolio, there's W. It's Broadcom, Chipotle. Oh, we didn't adjust any of our hedges in the end. That's right. We didn't adjust our hedges. So our major hedges, which is the SQQ, TQQ, and TZA, we did not adjust these hedges. We left them as they are. And yesterday, the short-term portfolio was 119, and today the short-term portfolio is, well, it's going to have to be re-signed in, I imagine. So 119, 128. So it's up, what was that, like only 9 million. So it's about $9 million from yesterday from when we wrote it in the morning, but that's without being changed. We feel that we're well covered. I think we have $480,000 in these three hedges in SQQ, TQQ, and TZA. We have $480,000 worth of protection in our long-term portfolio. And meanwhile, you know, I say all this stuff to, you know, I want people to be on their toes. But the bottom line is we have a lot of bullish positions. We have 19 short puts. We have 32, 34, 35 long plays in this portfolio. We have 35 long positions in the long-term portfolio. So I don't expect a very big pullback, or not one that would last, because I think that the government still, if push comes to shove, will do stimulus. The Fed, if push comes to shove, will reverse their stance and go back to easing. I don't think they've done their last hurrah yet. So I think that if there's a dip, it'll be a recoverable dip, and we'll have to decide what to do then as far as after that. But this can keep going on. Just because we're in trouble, and just because it's clearly going to be a party that ends at some point, it doesn't mean it's going to end tomorrow. And so, like our hedonism vacation or whatever they call it, enjoy it while it lasts. You know, this is the all expenses paid fun resort, and it's not over yet. In a couple of days, yeah, you're going to have to go home. And maybe that means in a couple of quarters. At some point, you're going to have to go home and pay the bill, but not yet. But the Fed is preparing to pay the bill. And they're telling us to be careful. And if we don't listen, then we're foolish. So just keep your eyes open for this stuff. That's where we are at the moment. So Michael says, why are the markets off to the races? The markets are there. I wouldn't call this off to the races, frankly. I mean, again, it's perspective. You guys get all very caught up in your 5-minute charts and everybody's staring at the futures indexes and whatever. But, you know, this is what happened today. It's not off to the races. We're still way down here at the bottom. Now, this is very urgent. This is very important. What kind of W are we going to make over here? You know, the market loves to make W's. And if we go all the way back up and it starts mirroring this to go all the way back up here, then you know that we are in an incredibly strong market. All right. But if we get to here or below here and then it starts dribbling back out, then this downtrend becomes significant, right? Even worse, if we don't make it to here and this downtrend is significant. So if we don't get back over 2200, which is where we keep saying is a critical line on the Russell. If we don't get over 2200, what happens now? Now 2200 is the continuation of this downtrend. So if we don't get over 2200 and we start falling, that means this big downtrend is in place. Then you got to pull back out on your focus and say, whoa, what kind of downtrend are we talking about? We're talking about this kind of downtrend. We're talking about getting all the way back down to the last time we had serious support of 18 or 16. That's a big drop. That's 15% down from here. Or actually, it's if that's 1800, 2200, 400 points. So 400 divided by 2200. Whoops. Yeah, 18%. So that's the drop that we're hedged for in the short-term portfolio. We're looking for that. We're hedging against a 20% drop. And that's what we expect is the worst case scenario. We don't think we're going to go below that. We think we're going to normalize back at where we used to be and then sort of drift along there. 20% of the NASDAQ at 16,000 is 32. So we'd be at 12,800, which is down about here. And for the S&P, 20% would be 9. So we go from 46 to 37, which is here. And for the Dow, 35 minus 7, that'd be $7,000, a 7,000 point drop. That seems drastic, right? That takes us down to 28, which is back here. So that's what we think the worst case is getting back to like the 2018, 2019 levels. We don't think we're going to drop much below that. Could happen though. But if that's the case and we hold that, then a little pullback in the Dow won't hurt us. And not only that though, but what would happen if the long-term portfolio gets whacked, but we're going to have an extra $450,000 to spend from the short-term portfolio. And that is 25% of this total portfolio. So we get $450,000. What are we going to do? We're going to improve all these positions for the next 2 years. And then if we drift along or whatever, you know how we do it. Even if it's flat, we're going to make our money. And in fact, that goes back to this, right? This is a very good lesson for everybody. In fact, that goes back to this. The richest man in the world here, 1987, $20 billion. He had a string of setbacks, $15 billion, same guy. 16 billion, he went down a bit, goes up a bit. Here's a different guy, 18 billion. He went down to 13 billion, was still the richest guy in the world. That's how bad Japan got hit that time. 9 billion, back to the same, that other guy. Here's this guy, and he's down 8.5. Richest man in the world is half as rich as he was as the richest man in the world in 1994 is not even half as rich as the richest man in the world in 1987. Okay. Then Bill Gates comes on with $12 billion, 13 billion, 18 billion, 36 billion, 51 billion, 90 billion. 60 billion. Holy shit. It was not a good year for Bill Gates. But why is that? This was 1999. when Microsoft was insane and everything was insane, and his wealth was tied up in his own stock, and Microsoft crashed in 2000. So I would have to say this number comes at the end of the year where they figure this out. And then he starts building it back up and recovering, but still, 52. He had what, 58, then still 52 in 2002, 40. Oh, that must have been when he was letting Steve Ballmer around the company. 52. Anyway, point being, obviously there's a bunch of guys that are around the richest man in the world, but you can't help the overall economic conditions. The world does contract, and people's wealth contracts. Your wealth will contract at certain points. The thing is, what are you going to do about it when it happens? What does Warren Buffett, and that's how this guy benefited, because what does Warren Buffett do? Warren Buffett does what I do, or I do what he does. I guess he's older. Not much anymore. God, I used to think of Warren Buffett as like the super old guy. Now I'm like, well, he's a bit older than I am. He's only like 20 years older than me. 30? Is he 88? He can't be. No. Let's answer that question. I'm 58. I'll be 59 soon. How old is Warren Buffett? 91. Wow. Okay, so he's 30 years older than me. That makes me feel good. Good. Anyway, because you always see, I was thinking of him like an ancient guy, but now I'm like, he's only a little older than me. Anyway, so what does Warren Buffett do, and what do? We take advantage of that. How do we take advantage of that? When the market goes down, when the world contracts and everything goes down 20%, 30%, whatever, instead of just staring at the portfolio and praying it comes back, we take the money from the short-term portfolio and we use it to buy more stuff in the long-term portfolio. So what does that mean? If the long-term portfolio is $2 million and the market contracts 30%, then let's say this portfolio goes down to 1.4 million, right? So it becomes 1.4 million, but we have $500,000 from the short-term portfolio. So we take the 500,000 from the short-term portfolio and we increase our holdings of stocks by 30%. So now we're back. Now we have 2 million in long-term. The same 2 million we had here, we now have in our long-term portfolio. But then when the market recovers and goes back up 30% times 1.3, now we have 2.6 million. So when other people are just barely recovering what they had, we've jumped up 30%. This is a great advantage to hedging, is because you have money given to you at the time everybody else is getting killed. Then money starts pouring in from your short-term portfolio, from your hedges. That's how you win when you have a hedge. But it's a long-term process that takes. It only works once every 10 years. It only works when a market cycle, when there's a crash. But once every 10 years, you get a big pullback in the market. You reinvest your money. It's not every 10 years, really, because we already went through the cycle twice in the last 2 years. We've had big pullbacks where we've taken more cash. And we've done it. And it's not necessarily you have to use the cash. We have 1.7 million in cash here anyway. It's not necessarily that you've got to use your cash. It's that, you have to move the cash from the short-term portfolio, but it's possible that if everything is terrible, then you do. But if not, it gives us the courage to deploy this cash. Why? Because we have $500,000 worth of hedges. So we can afford to deploy more. That's why now we have 35 long positions, because we've added a whole bunch of long positions recently. We doubled the size of the money tour portfolio. We doubled the size of it in the last set. Why? Because we happen to hit it at a decline. We hit the we hit at the time I was on the show, which was December 1st. Where are these charts? Not those. So when I was on the show on December 1st, we were down here. This is the night I was on the show. So I said, let's buy everything, because I felt this was going to be a good bottom to buy, and you don't get a lot of chances to do that. And it's incredibly rare that I happen to be on the show when there's a big buying opportunity. So when I was on that money talk portfolio, I said, you know what? Let's buy all of our runners up for the trade of the year. And so we did. And why were we able to do that? Because of the same thing. $159,000 of cash on the side of a $200,000 portfolio. It was 167 at the time, in fact. So we had tons of room to add. We only had $47,000 of cash exposure in the portfolio. Of course, we have put exposure, but how much is the put exposure really? We have to buy 500 shares of Boyd. We have to buy 1,000 shares of gold. These are not things we don't want. We have to buy 4,000 shares of Hewlett Packard. We have to buy 2,000 shares of IBM. We have to buy 2,000 shares of Intel, 1,500 shares of Philip Morris, 1,000 shares of SunPower, 1,000 shares of Viacom, and 500 shares of WBA. So, it's not major commitments. Can we afford all that? No, we can't afford all of that. And we'd have to make decisions. We'd have to cut some things as things started going down. But do we want all of those things? Yeah, absolutely. I want 2,000 shares of Hewlett Packard for $27, only $54,000. I'd love to own Hewlett Packard for $27. It's currently at $35. I certainly would love to have 2,000 shares of it. We're never going to have 2,000 shares of it. It's just going to keep going up, and we'll make our money. But if push came to shove, not a problem. Do I want to own 1,000 shares of Barrick Gold for 23? Yeah, I do. It's not even at 23. It's only at 17 now. But would we own it for 23? Sure, that's not a problem. We'll work our way out of that. 500 shares. I'm not sorry. 1,000 shares of Boyd at 60. I'm sorry, 50 is $50,000, but it's currently at 60. It's 20% below the current price. So if we were worried that the market was going down, we would first of all start trimming our put positions so that we don't get these awkward assignments. Once we trim the put positions, there's no demand on our cash. Then we're only worried about losing $47,000. So in other words, if I cashed all these puts out now, we would have less cash, but no obligation against the cash. So we'd still have the same $47,000. That would become, if we killed all the puts in the portfolio now, and let's just do the math real quickly. How much are all the puts? 5,600. Let's call that 7, 12, 13, 17, 27, 33, 30, let's say 34 at this point, 35, 36. I'm sorry, wait, no, 30, let's say 37 there. 37 and 7 and 2 is, let's say, 47. And 47 and 7 here is 54. And 3 more is 58. So let's say $58,000. So what would happen if we killed every single put we have here? We would have $100,000 in cash. We would have the same $47,000 in securities. And oh no, I'm sorry, no, that's not that. I'm sorry, no, the security value would go up to $100,000. We'd still have the same $200,000 value. We'd have 100 in cash and 100 in securities, because these negatives would come off and it would increase the security value. So we would end up with 100,000 of securities and 100,000 in cash. So we're still 50% in cash, even if we kill every single one of these puts. That's what you have to realize about the portfolio. So it's not that you say, oh, we can't afford to buy $100,000 worth of IBM. We're not going to. If things go bad, if it starts going negative, we'll kill the puts and we'll spend the cash, and we'll have less cash. But we're still going to have plenty of cash on hand, and we're still going to have the same portfolio value, or a little bit less, obviously, if you're killing the puts because it went down. And then we could take that sideline cash and do the same thing we do in the short-term portfolio and the long-term portfolio. We can apply it to make our positions better when the market changes. So that's the long-term strategy, and that's why we don't really have a fear of where we are right now. We've got plenty of cash. We can easily pull the plug on the puts if push comes to shove, but we haven't even violated any scary levels of pullback yet. So if the Russell can get back over 2200, which it's probably not quite. If the Russell gets back over 2200, that's the only danger sign we have right now is the Russell pulling back. Like I said, if the Russell keeps falling, then everything else is going to follow it eventually. If the Russell can get back over 2200, it's going to stabilize, and the other indexes will stabilize also. All right, so we'll see. But it's not, the party is not over yet. We still have a couple of days left in paradise. And the Fed just did the responsible thing, and hopefully we won't get a very big tantrum about it tomorrow. We might. But this is a very good sign. People are being very mature about what's going on so far on the Fed. So we'll see what happens. What's it doing to the dollar? It should be great for the dollar. Look at the dollar too. So think about that. These markets are holding up really well against a very strong dollar because this is what the Fed just did. They just said, you know what? We're not going to keep throwing money at everything. And that's great. All right, so now Powell's talking. Oh, well, he's just on my TV. Hang on a second.
Implying that increases in our securities holdings would cease by mid-March, a few months sooner than we anticipated.
Oh my God, okay, I'm bored. Whatever. You got to sit down for the Q&A for this guy. It's not really matter. It doesn't really matter what he says right now. All right, so I'm going to go watch this, though, because I do like to watch this and hear all the questions. All right, so all is well, I suppose, and let's just take a look at what the indexes look like. So keep in mind, this is actually a very good reaction because the dollar shot up. How much? Dollar. So the dollar shot up from 60 to 80 is about 2.5%. So the dollar's up 0.25%. Sorry. No wait. Yeah, 0.25%. So the dollar's up about 0.25%, and the indexes are moving up as well. Not much, about the same, about 0.25%. But it's harder for them to move up when the dollar's moving up. So we're getting a very good reaction off of this. It's a move people wanted to see the Fed do the mature thing. And I like this. I like going long on silver if it gets back over 22, but then use a very, very tight stop on 22. And otherwise, natural gas never hit 375. If natural gas hits 375, we still like that for the long line. And other than that, I wouldn't mess around until we see what happens, okay? And we'll see what happens tomorrow. There's not much we can do about it today. All right, thank you everybody for coming, and we will do it again next week, all right? Take care, everybody.